Hi, welcome to our webinar today. We have a lot of important topics we're going to cover. We're going to focus on inadvertent ways that you as an owner can actually make your non-recourse CMBS loan recourse. We've got some great speakers today, and I want to give them a second here, just one second to introduce themselves. And you're going to hear a little bit more from them than you will from me. We are going to, this webinar, unlike our other ones, is not being recorded because the information is too sensitive. So appreciate you attending this, and we're going to actually, you'll see here in a minute, we're going to use a real live new CMBS loan document, which we peeled out the carve-out guarantees, and that's what we're going to go through. And, you know, I think we all know CMBS loans are non-recourse, but there are ways to make them recourse. So that's what we're going to focus on today. And with that, let me, Keith, would you introduce yourself, and then Will?
Sure. My name is Keith Mullen, and I've been around finance and real estate finance since the mid-'80s, representing institutional and lenders and banks at two different big law firms. And now I'm at a small firm, and I've jumped the fence. And I'm having the really pleasure of having learned the game from CMBS 1.0 going forward, and having been around all that, the whole maturation of this wonderful product. It's really, frankly, enjoyable to be on the borrower side because I know how the spaghetti's made on the origination side, and I've also represented some special servicers during that tenure too. So it's a pleasure to be here, and frankly, I'm really looking forward to what both of you have to say as well.
Hi, Will LeMay. I'm with First Service Solutions as of about 3 weeks ago. Most recently, I've been working in the last 20 years in servicing shops, primary servicing, special servicing, did some master servicing for a while for all types of securitized product, also done on balance sheet lending, anywhere from full recourse to non-recourse. So been on the servicer side of the house and enforcing these documents for the majority of my career. Before that, I was in the private practice of law, representing developers in the Northern Virginia area, leading into a big crash cycle, and was on the side of the house where some of these documents were being enforced. So bring a perspective from both sides of the fence, and happy to be back working with borrowers on how to get out of trouble, stay out of trouble.
That's what this will focus on, hopefully, is keeping you out of trouble. Okay, there's actually two types of recourse, and we're going to talk in general about making a loan recourse that's non-recourse, but there's actually two types. One is where you're exposed or you're going to be personally liable up to an amount based on actual losses, and the other is where the full loan becomes recourse. So we'll try to differentiate between those as we go along. I'm going to spend literally 2 minutes, 3 minutes on the things that I think most of you sitting here today, probably even attending this webinar, are saying, you know, I kind of know what these bad boy carve-outs are. I've heard them, seen them. I kind of know what they are. And I would not do anything intentionally here to ever cause anything bad to happen. And that's definitely what we think. These are the ones, the first section here that I'm going to go through are the ones that you probably mostly think of, and then for the most part, they are controllable and they are bad, and you know when you've triggered them or not. First one is fraud, misrepresentation, failure to disclose a material fact. You can prevent that. The other one is breach of a rep and warranty in your loan docs. And as I said before, and I just want to reiterate, each page we pull up will be a Romanette, if you will, under the carve-out language in the loan document. So each page here is, in fact, pulled directly from a standard CMBS new loan document. And we can certainly share the slides with you as you're attending this after the fact. So happy to do that. The other one is criminal activity, if you lose your property due to criminal activity. And the last one is relative to security deposits. Maybe you could elaborate. What I think it's if you don't give them to the lender if they're looking for them.
Right. And I've always seen this as, well, you better have an in-house management company or management company do you like, because that's that intermediary position where even things such as fraud, if there's an intermediary, something can happen at that station. So the tenant might have an environmental problem that you're not really realizing, oh my gosh, now I'm backing that tenant up if the tenant goes away. And here on the security deposits, the same sort of thing. If the management company is in charge of the money in bank accounts, you really need to understand that you're the credit enhancer of the management company, because your exposure is to the lender for this topic.
Well, that's funny, because I thought all these were the ones they could control, right? So I guess there's even some things we're going to get into now, and this we're going to now have Will and Keith give a little more detail. This is now relative to your cash flow and things that you probably aren't focused on. So the first one has to do with physical waste or damage to your property.
So I think it just stated in its broadest terms or its literal terms, this comes to mind that of course I wouldn't let my property go in the tank physically, because that hurts the value. So there's an obvious piece of this, but part of the theme you're going to hear from us today is how some of these things can chain together and lead to one another. And so we'll start with this physical waste or damage. This really becomes an issue on cash flow when there's just not enough money to maintain the property. It's got to come from somewhere. Is there non-recourse loans? It may not be producing enough money to make the repairs. There aren't any reserves. And so you put yourself in the situation of having to either come out of pocket to repair the property, make the property tenantable, or not. So I mean, Keith, you have anything to add on that?
I think just another good example of if there's a casualty event, and living here in Texas, we're close enough to the Gulf, seeing hurricanes come through Louisiana all the time. And if you get into an argument with your lender as to the insurance coverages and whether that lender has the right to do certain things on the insurance policy, and the property sits there unattended, it's starting to look like material physical waste. So I've had a couple of outside counsel for the lender side start to intimidate or intimate that if we didn't get it this wrapped up quickly, there may be a material physical waste claim on the table.
I've also seen situations where you may get pushback, not for necessarily physical, but they start talking about value waste. I don't know if you've seen this, Keith, where there have been issues where maybe there's you've got a new lease that you're trying to come to terms with, and they're just not very good terms, but the lender thinks they're good enough. And if you hold up the lease, it's not necessarily to say they're going to trigger the recourse, but they certainly may threaten to trigger the recourse based on some waste theory.
Sure.
Okay, the next one, and this comes up a lot, is misappropriation of rents. So what do they mean by that? And I'm not going to steal the rents, but what all could happen here?
Well, I mean, I don't know, Will, when you first read this, but I had to take 5 or 6 breaths before I even got to the end of it. And it's a problem when it's A, B, C, and D. And so this is a really thorough clause. The insurance misappropriation of proceeds doesn't bother me too much. The rewards of condemnation, that may not be a realistic risk. But once you start getting to C and D of gross revenues or other funds from the documents in connection with anything such as the clearing account agreement and cash management, this is a real live situation here. And some of your thoughts, and I of course have a few as well.
Well, from my days as a servicer, where we would most often see this come into play, and the question would get asked, are two very specific reasons that you mentioned. One is you have a casualty loss at the property. You go about negotiating. It's not a huge one. Say it's a $300,000 loss on a $20 million loan. So not huge. But so you negotiate with your insurance company. You get the check. The check's made out just to you. Your loan document is going to say it needs to be made out to you and the lender. Under the loan documents, if you read the insurance provisions and the loss provisions, it says you got to send that to the lender, and they're going to administer the proceeds. We see, just as because you're working to fix the property, keep the property up and running so you don't run into the waste provision, you go ahead and do the work. Technically, under the loan document, that is by this definition, a misappropriation of rents. Now, whether that leads to anything bad happening at a later date, who's to say? You may have spent the money exactly right, but now you put yourself in the position of having to prove that up or have this sledgehammer sitting over you. That probably could have been avoided.
And you said turning the money over to the special servicer, and we all know, getting back to maybe some of these other slides, once you get into this kind of payoff situation, that lender will never give you credit for the money they're holding from that. So
that's right.
So it really cuts both ways, because once you give it to them, it's gone.
Well,
let
me ask you guys a question, and we didn't rehearse this at all, so I hope I'm not putting anybody on the spot. But
I think it's evident we didn't rehearse it.
I know, sorry. We're seeing live today, and where the loan is property's cash managed, loans cash managed, I should say. You got it. Let's say a hotel. Let's just pretend there was a pandemic that hit, hotel closed down, and maybe it's not closed. I'm getting 2% occupancy. I'm getting a few rents in, but I need to use those to pay my operating expenses. So I opt to not put that money in the lockbox account, because I'm going to use it to pay. I got to pay payroll and stuff. Could that be under this category of?
Absolutely, and that whole waterfall, once it gets into cash management, is really painful. In some states, for example, you have to turn over the clearing account. You have to turn over at once in the cash management, but at the same time, you have a regulatory tax schema where you're supposed to pay taxes on that every night. So it gets as basic as that. Even that first move can have practical problems. And of course, the waterfall, early in the waterfall, the special service can apply it against any amount of the loan whatsoever. So this is really, really big. And
that's an example where you could really inadvertently, innocently, because of unprecedented times, fall trap under this. We should probably, before we go to the next one, we should maybe, because we're all caveating this with, you might win the battle and all that. I think what we're trying to set here is an awareness of not only what could happen, but what we are seeing in some instances. Should you lay awake tonight because one of these things we're talking about maybe happened? No, most of these things can be fixed, if you will, but it's the worst thing is to not be aware of it. So, and then maybe you win the fight in court, but in the meantime, how much, legal dollars are you spending to get there, right? So yeah, I could, if only this were on video. Yeah, you could see their faces. Okay, so now now you've got, so I know about misappropriation of rent. So I put all my money that I get, even the 10 cents I get that during this pandemic, and I put it in the lockbox account. Surely they'll give me money to make sure that I can pay all my expenses, right? What happens if they don't and a lien gets,
Well, and that is a real life example that we're dealing with right now, where the money, all the proceeds get cash trapped. They're sitting at the special servicer, but the borrower actually did spend or did engage some vendors to come in and do some work at the property.
Because it makes sense for the benefit.
It makes sense. They got to keep the property, otherwise you're facing waste. You've got to get it done. Now there's no money in the property to pay those vendors. During the pendency of time of trying to get that money out of the lockbox, now the vendors have put a lien on the property. Because it can take time. It's not an overnight. You don't just, send a quick email and get the money out immediately. It takes some time, and you have to really set up a process to get the money out. The whole concept of a waterfall, Keith alluded to this earlier, but the whole concept of a waterfall, once you're in cash management, is really goes out the window. Everything is at the discretion of the special servicer, any proceeds. So what you're asking is, give me the money. During the pendency of time, you could get a lien. And that it's not, we're seeing that right now. And because you've done up to this point everything you're supposed to do, you put the money in cash management, you've actually engaged the vendors, and now there's no money to pay.
Well, now, did you have to?
Yeah, and that's a problem, particularly in some states that have covenants of good faith and fair dealing. They're just implied in the documents, like maybe California or places like that, or in Texas, where you can get your gun out and shoot each other and it'll be fine. You can't depend on that. But
That's right.
That is a really big problem. And so thus, what happens is that we've got to feed the property. And then it becomes what we hear so often is that people are thinking, oh my gosh, my balance sheet, my personal wealth is just being sucked out here. This is a problem.
So let's say that, let's say again, I put all my money in the lockbox account. I now have liens because I don't have money for that. I think this next, I want to add a comment and then hand it over to you guys. But the loan document that is standard that we pulled this from is a very, very active CMBS lender today. These are standard documents. Many of you, appropriately so, have maybe negotiated this language before you agreed to it, but we've seen many people who haven't. So what you're saying then, I think here, what this document says, and I'm not a lawyer, I'm the only non-lawyer here, so you'll have to correct me, but I gave all my money over that I got. It's in a lockbox. I can't get any money out. They've even escrowed me for taxes, but of course there's not enough money in there. And now the tax bill is due. Are you saying it's recourse if I don't pay the taxes, even though I don't have any of the money?
Absolutely.
Under these documents, yes. We have seen people success, and the time to do it is before you close the loan to negotiate. It's hard to negotiate afterwards because you don't really have any leverage at all. Under negotiated documents, we've seen this where it says you're only liable if there was money available out of the property and you didn't pay it,
or it's escrowed.
Or it's escrowed.
Then the lender.
Yes,
does
the
it.
lender then pays.
And there may be other expenses that are more alarming to the servicer, but taxes, that they jump over the priority of the lien. So they will probably pay the taxes first because if they foreclose, they have to pay the taxes as well. But there's all those other sorts of costs, just the whole vendors, mechanics liens and things like that, where they just shrug their shoulders.
So if I don't negotiate this as an owner, I'm basically agreeing personally in situations where the property doesn't cover it to personally cover the taxes. Is that right?
That's correct.
Exactly.
Okay.
Exactly.
And surely, and the amazing thing is the same thing for insurance here, right?
That's right.
So if I don't have money from the property to cover it, all those same reasons, I still have to keep insurance on.
Yeah, one of the interesting things about casualty insurance, if you bring in your own insurance policy personally, understand is the servicers don't care whether they're a policy holder, whether there's a loss payee. They will leverage all these other tools to grab that money, even though they will try to act like the policy holder as well. So it's really, really tough.
Correct. But yes, the insurance falls under the same category as taxes, and they often go hand in hand.
Yeah. Now I think the next one is probably the one everyone's heard about to some degree, and obviously you guys are going to give a lot of input here, but what are you going to cover the Cherryland Mall situation? Keith, yeah, but I don't know if we need to. But the bottom line is most of you probably know on this call that there's two ways to get your loan to the special servicer. One is missing two payments. Now, that doesn't that's way outside of what we're talking about today. I'm just talking procedurally. And the other is to declare, make a statement in writing that you are going to miss a payment because of let's just say again a global pandemic, right? So I don't have the money to make my payment. How does a borrower maneuver if I say in writing that I can't pay my debt? Then how does this work?
This is really interesting. So far, we haven't seen, in my experience, haven't seen the servicers take that and make it into a recourse event. But it's ticking out there. I haven't heard any of them say, okay, boom, here's that letter saying, I'm not going to make it. Oh, boom, now I'm going to shoot you with a gun. But that's what it literally says.
We had them hint.
Yeah.
We haven't seen a borrower get a letter declaring or taking a legal position that they've now triggered recourse. But we've been on the phone with servicers where they've started to take that position. Now, whether they will go forward in this public policy world and do that, it remains to be seen.
Just somebody else here, we don't have a bunch of beer here. We're not just sort of dreaming up things. Let's just pretend like we did. And so I've always kind of thought, what if it goes into receivership? I mean that that definitely says the borrower can't pay. But again, that may be more of a lawyer sort of thought out there as opposed to what the reality is.
But the bottom line, it sounds like a borrower needs to for sure have good advice from an advisor like we are, or a lawyer, somebody about how to craft the letter that they send in to say, hey, I need help, I need to get transferred. I mean, we have to be careful we aren't blatantly putting in writing that I can't pay my debt, right?
Right.
And then who knows? Okay, now, so those were the ones that are cash. And as you can see here quickly, I don't know about quickly, but as you're hearing, it's a little bit of damned if you do, damned if you don't. There are plenty of places, it's almost like walking through a landmine where you might miss one, but then you've stepped on another one or another one. So CMBS, these carve-out guarantees are probably the most important thing you need to understand in CMBS as you maneuver. Okay, we're going to talk a little bit now about your I'm sorry. William,
I think just before we move on, I do want to make a point. We sort of walked a little bit around, and it's another thing. These are reasons that servicers could claim that the deal is now recourse in either partially or full. That doesn't mean ultimately that they will win, but that really doesn't matter a whole lot in the negotiation phase, because by having these situations occur, that's just another piece of leverage that the servicer now has to use in the negotiations. And goodness knows the deck's already stacked against you when it comes to leverage. We're here trying to give you some idea about how not to give any more leverage to them, even if they don't win. And you win, so what? You've won. Now you've spent a lot of money winning. So.
Oh, great point. Yeah. Absolutely great point. So just, for the sake of just simplicity of understanding, we've kind of broken them into categories, and you saw the ones that we said were really bad, the fraud, the criminal activity you can hopefully avoid. Till Keith showed an instance of where it could happen, and you didn't do it on purpose, but those you can kind of hopefully avoid. We talked about the cash. Now we're going to talk a little bit about organizational structure. And I think most people know that this first one, I can't, if I'm the borrower, I can't transfer my property to Will LeMay and certainly not get lender consent. But talk a little bit more about this. And I know we have this visual up here of a gun. Why is this looking so scary?
Well, I think where we're starting to see this, and we could have put this almost in the avoidable, because everybody knows I can't just go give my property, transfer the property to someone else. Where we're starting to see this in real life is through inadvertent transfers or transfers through the loan documents that you never contemplated. Things like lender rights that the mezz lender may have and may spring in a default situation that could technically trigger a transfer of ownership interests that might meet the threshold that's required for lender approval. And so it sort of works together with that.
And I've seen some loan documents really go deep in this. So we saw in the 80s, for example, people would start transferring rights to receive income. There's all the bundle of rights that don't amount to title. That's something less. And of course, this language says, or any interest therein, or any direct interest in the borrower. But that's where, when we really get pushed against the wall, then that is ways that we start thinking from the borrower side. How can I raise some money? How can I get a capital contribution? How can I bring money in from I could put the money in and get a pref return and things like that. And so that's this kind of stuff that people think about, that we should think about, that we have to examine in those documents.
Well, and one that's it's probably on everybody's mind here, and I just read an article today on this that I questioned, but as owner, here we are in month 10 or whatever of 11 of COVID, almost a year of COVID. Maybe you've got basically no income to cover your debt and all that, and you've got maybe someone who's willing to, Keith Mullen says, hey, I got $1 million, I'll give it to you, Ann, and help you out with your property. And okay, there's no government relief available to me, so for CMBS, and so that's a good solution. So I'm just going to bring him on, and thank God he's here. Now, of course, in that, Keith would have some conditions on that $1 million he gave me, and those conditions might include that he gets a little control over what I do, and we all understand that. That's an inadvertent way you can trigger this, because the minute a new capital provider coming in has any control rights, you could be effectively transferring and causing.
This is a great example of the minefield. They need you to watch where you put your foot.
Yeah, that's right. Okay. All right. This one, I have to admit, it's definitely more legal than business. I'm not even going to try to. So help us understand what this means.
Well, you're a lawyer too.
I'm not practicing though.
It's this substantively consolidation. It's a bankruptcy term of art, but that if you just started merging all your assets into something else, there are through receiverships and state actions and federal bankruptcy court actions. But anytime you hear the word actions, that means liability. So to my mind, you don't need to understand much more of that, because once it becomes an action, then it's liability. So this is a hardcore, because those laws come in, frankly, and the lender loses any control over the property and the assets. So this is truly the atom bomb situation that they need to avoid.
And the reason it's here is it's out of your control. I mean, you're obviously, if you go and you merge with another, if you take your borrowing entity and you remove the SPE, bankruptcy remote provisions, and change their organizational structure, that's all avoidable for you. But if a court comes in and by operation of law it happens, you're on the hook for it. That's the risk that, you may not have any control over it, but you probably had some control up to the point where the court is asked to make that decision.
So the next slide or the next section of these documents is the SPE remote entity. Is there any difference in this one than the last one?
Well, if some of those SPE covenants are easy to mess up on.
Can we, what we should do for anybody, I hate it, I've sat in, I'm sorry to interrupt, sat in webinars or things, and I hear lots of acronyms, and so you wouldn't be on this webinar unless you understood most of already what we were talking about. But SPE is probably one of those things we throw around every day, but it's a single purpose entity that is bankruptcy remote. That is, you can only have, your one property, your one loan in that entity, and just to protect that trust from broader liabilities from you. So there's all kinds of recourse and issues if you don't keep it in that bankruptcy remote entity.
And it's 15 or 20 things that are built on case law. It's as obscure and small as, bank accounts are just by this entity and things like that. It's very, very detailed. but the roadmaps and the documents, you just need to be aware of it.
Yeah, I guess another good point to add too, and we took it out of the slides, but almost all of these, I don't know why you lawyers do this, but every document you read, every paragraph refers you to another section, which when you're there in that section refers you to another section and so on. So I took out the reference to the sections because it wouldn't make sense on a webinar. But I think that's an important point, that all of these paragraphs, or a lot of them, refer you to various sections in the document. So good point. So you're saying in the SPE section.
I literally, when I get in these conversations, to get my crayons out with different colors and just talk, it's just sort of this matrix that you.
Yeah.
Because it is, everything's linked.
Yeah, I know. Makes it really hard to read. I run out of fingers sometimes, when I'm reading a document. Of course, people do it electronically now, but I still like the hard copy, and I put a finger in one spot and then another finger, and pretty soon I can't. Then I'm done, right? When I run out of fingers. Right. Okay, let's talk about the next one. So I think I'll let you guys just start on it, but your loan, when you get it, it gets securitized, and that's a lot of what this is relating to. But
yeah, we don't have to spend a lot of time on this because this is usually over and done with in pre-securitization or within 90 days after the securitization. It's for if you've done something that gets this kicked out of the securitization, and there's a loss to the trust because of it, or the contributor because of it, you're going to be on the hook for it. They're not taking any risk. So we don't spend a lot of time on that.
This clause is to protect your mortgage broker
correct.
or the lender who didn't solve it. And once it's sold and gone, it's gone.
Okay, all right. Okay, now this next one, boy, we've got lots of stories on this. But subordinate financing, and I want to just start out for, again, the non-lawyer, very layperson approach here is we have many borrowers that we talk to that say to me as we're talking, COVID hit, had these problems. I went out and got an EIDL, an emergency disaster loan. I forget what the I stands for, but anyway, I went and got that, and thank God I got it, because the first thing we do on this side of at First Service is our antennas go up and think, okay, so we're going to have to deal with that but even now, would you think, this means any financing, right? Give some examples here.
Well, it means more than that, but yes, that's what's coming to mind to everyone right now. And we haven't actually seen servicers that are right now taking a hard line approach other than having to approve it. The 2 rounds of PPP, Paycheck Protection, and then the EIDLs, they just want you to ask for consent. They'll acknowledge the consent. We're seeing that. Of course, you can't go out to your merchant bank on the corner if you get into trouble and need more financing and take out a second lien on the property. That's pretty obvious. The most real life example that we see, again, it's fixable, but it causes the servicer to raise their eyebrows, and of course could create one of these leverage situations. Is property's been in trouble now for a year. You've been feeding it. Like most borrowers, property owners do, that when they feed the property, they make loans to the property, which may or may not be, depending on the sophistication and how many lawyers. They may loan to the borrower, and then they will put it on their balance sheet as some form of subordinate debt. Now, again, that can be remedied at some point. But the first thing that a servicer is going to see when you send in your financial package and start asking for relief, and they see $800,000 of subordinate of other obligations, long-term obligations on the balance sheet, they're going to ask, what is this and why didn't you have us approve it? Usually that's very fixable by simply converting that to equity. You just compute it because they're not going to stop you from putting in your own new equity in. But if you document it as a note and it has payment terms, even if it is fully subordinate, they will hold you to that.
I've seen it even as little as innocent as loan to, sponsor, right? So it's not even documented. It just was booked as, a loan due back to me. I loaned the company money. So it doesn't even have to have payment terms right? I mean, it can even be like that.
Correct. Yes. It gets more and more serious and harder to correct the more documented it gets. If it's just I'm writing a check every month to the operating account to pay payroll or maybe even make my debt service, and I just book it on my balance sheet is due back to me as the guarantor or a partner of some kind. That's less of an issue because it can be very easily fixed without. But if you've got an actual promissory note with a loan agreement and repayment terms, then you start getting into more. They're still fixable, but you could run into other issues.
And boy, this is all counterintuitive in the bank and the life company world because you want people to feed the property for the betterment of that.
Correct.
So it's this different mentality here.
But I think a common theme here is almost anything that you would do, even though you're obligated to do it, or it's the best thing in your best interest to do it. You want to make sure that it's being done according to the CMBS rules, and the arbiter of those CMBS rules at this point are special servicers. And
I think actually a theme of what we're saying here, I mean, everyone's going to leave here and say, man, I don't know quite how to word that appropriately for the webinar, but there are ways to do things with your CMBS loans. You just have to know these exist and know how to do it, right? So, I mean, that's the key is you got to have guidance. And before you close a document, don't do it without knowing the stuff. Okay, let's assume now, so the next whole category of things, so now I'm gonna go fight the servicer. I'm mad, I'm frustrated, and I'm gonna go fight, all right? So at first you'd sit here and say, well, okay, I can avoid that. That could be under the avoidable. But let's put this in real life terms as to what we're seeing today. So you're a borrower, you had a lockbox. I'm going to say it's a hotel's easiest one to make sense. Your hotel is at 10% occupancy. Through COVID, you took your rents, you had to pay your expenses, or let's just say you put your rents, your income revenue in the lockbox account and didn't get money back, and you've been you've been arguing and asking and pleading and begging to get money back. You've had to fund your operating expenses out of pocket. You've had to pay your taxes out of pocket. You've had to fund all this money, and all this time you're just asking for some relief, and you're at what's end. So you're like, okay, that's it. I mean, I have to take a firmer stand here. I have to do something. I can't keep doing this, and yet I can't admit my inability to pay in writing, and so I'm just sort of stuck. So I'm gonna go. That's it. I'm gonna hire my lawyer. We're gonna go in, and I'm gonna take a tougher line here. So this first one, which can make it recourse, right, is help me understand that. So
I think the most obvious piece is if the lender has to foreclose, it's the cost of foreclosure, enforcing any of them, putting in a receiver. That's going to be that's recourse, and it doesn't convert the loan to full recourse. This is one of those instances where it's the actual money spent. But I think that's pretty intuitive. Okay, yeah, I'm agreeing if the bank has to come in or if the servicer has to come in and foreclose. Where it becomes more of a fight, remember I said earlier, just because you win the fight, you could lose a lot of money on these. Say the servicer takes the position that this is now a recourse loan because of something that happened, and you fight them over it. You spend a lot of money on legal fees. They spend a lot of money on legal fees. This is the recourse provision where I've always seen them win, where you have to pay their legal fees to fight them, even if you win. So this is the no-win situation.
Okay. Now, what about the next one, which has to do with, custodian receiver, I should say, really. There's a lot of examples we have here, but let's say they're gonna come in and put a receiver in. What happens? What's this?
Of course, where the gun or the bullet out of the gun on this one is that you can't be going and getting it yourself. So that means you got to wait for them to get the receivership. Got to wait for them to exercise the remedies. And so it puts you in the spot again where you're just having to pay more out of your personal wealth, out of your personal bank account, because you can't consent to acquiesce or join in appointment of a receiver or trustee or examiner of any portion of property. You're literally in that checkmate spot where you have to just sit there.
So what if so now let's say I don't do that, right? And I'm let's say, and I think this before, I was thinking, I got them mixed up because, so let's say they're going to put a receiver in and I don't want to go along with it, right? But talk about this. What if I put up all my defenses, hire a lawyer, and I try to fight here?
You're fighting the wrong fight because you really need the advice and guidance to navigate where the path is through the minefield, not go in there with a bulldozer and hitting all the mines. And that's what this recourse event is. If you're going to go in there and start litigation, start in exercising common law rights, suing, you have just unlocked the plug in the dam, and it's going to be really tough. And that's what this invites them to your whole bank account.
Now, I would say that this actually has language that in it already that you should be negotiating every single time, which is an exception for valid defenses in good faith. Okay,
Yeah.
You don't have when you answer their pleading, you don't have to agree to everything. You're not giving up that right just because you oppose a foreclosure by filing your answer and saying no, those facts are not right. You're not creating recourse. That would be a truly perverse situation. It's the active interference with enforcement of remedies that this is really meant to figure into. Filing countersuits against them, for instance, could lead to this. We've seen that where the borrower says, no, not only am I not liable, but lender, you're liable because you've interfered with my contracts. You've not dealt in good faith. You've committed fraud. There's probably a forum to do that, but probably not. I think what Keith's point earlier is apropos here. But that's probably not the place to do it, is a countersuit to a foreclosure action. You probably should be fighting that at a different spot.
What this does, and how I kind of like to see it in spot on point, is that this takes away your ability to play offensive.
That's correct.
You can play defense. So you're sitting there waiting for the ball to come over from the other side of the tennis court, and it just doesn't come. So you can have a hard time finding some sort of assertive action you can do legally that you could clothe yourself as being it's a defense raised in good faith. Then you're just asking for a lot of litigation, a lot of legal fees. So this is tough. You gotta wait for the ball to come over the court at you.
Okay, now let's talk about a section. I think we debated and we said, we probably could have put this in the front under what's controllable, but bankruptcy. I think we all know that bankruptcy triggers recourse, right? That's the one everyone knows. So I don't know if we have to spend a lot of time on here, but what is there any other helpful feedback or anything that you guys want to cover here?
No, I think most people would understand this one. You can't bankrupt the property, and else they'll come after you as the guarantor. This is one of those full loss situations, and then your only option is to file the personal bankruptcy as the guarantor. And
and if you're dealing with COVID right now, so you had otherwise performing property, you're healthy financially, and you are trying to protect yourself due to the issues and the cash flow issues with COVID, this is not a good, and I've had many people say, well, I'll just file bankruptcy and protect everything, but okay. All right, now what we're going to talk about is something that I think is relatively new. I'm not sure that we have, well, I'll let you guys talk, but I'm not sure we have a lot of sort of recent issues with this, but what does this mean, this emergency law?
Will, you want to jump into this?
Sure. When we're just now seeing this start coming up in documents, we don't really know how it's going to play out, but we wanted to raise your attention to it so that you can, as you're negotiating documents, your counsel can look at this and sort of help everyone figure out what it means. But this and it's probably directly related to COVID. And the long story short is you basically need service or approval to avail yourself of emergency law, things like PPP and that along those lines, and you must abide by emergency law. That is, if within your jurisdiction there's a state order that you can't open, you can't open. An opening can create recourse. Realizing that if you don't open, then you've got a whole host of other problems you talked about. The long story is, you can read this. I think you'll understand it about as much as we do because we've not seen it come through, but we wanted to raise your attention to it, that it is new.
You know, I wonder, there was the Oregon statute bill 4204, and I only know that because I got a lot of Oregon properties I'm working on that gave, because of COVID, the governor came out and gave, the bill allowed borrowers to not pay for, till year end actually, and it required that the lender or servicer in this case put all the debt at the back end and all that kind of stuff. You almost wonder if this isn't meant to address that to some degree. You can't even take advantage of that sort of without my approval. I don't know, but we'll see. But I wonder.
Well, I think of the second page of this, which is page 30 of the slides.
Let's go to the next page. Yeah.
Yeah, that I think speaks to that. It's the borrower fails to comply promptly with any request made by lender pursuant to an emergency law. So it's just those situations where if lender says you have to have my approval and you go and do it and you don't get their approval, and that then interferes with their rights to enforce their remedies later on, you did everything you were supposed to do except ask the lender for permission for something that you had every right to do under the law. So what this is doing is you're giving up your right to automatically avail yourself of public policy determination that you're due this money.
Well, that's really so. This is, we're seeing new in new loan documents, we're seeing pandemic reserves and all kinds of things as a result of the COVID pandemic. I'm sure this is all meant to address that too. So the feedback for all of you on this call is, watch any new loan documents. I doubt that your older loan documents will have any of the emergency law in it, but yeah. I hadn't seen them either.
So. Well, I liken this situation to 2001 in the post 9/11 changes that we saw in documents as it related to terrorism and terrorism insurance.
Yeah.
I mean, people are sort of figuring it out the year following, but we saw all these new provisions pop up. You had to have this insurance, you couldn't finance it, and you can't get it, no, because it's not available. I mean, but there was lots of fighting, and you had tried to figure it out, and the industry had to mobilize and sort of figure it out. I think the same thing will come out here, but in the meantime, when we're in this period of uncertainty, you're starting to see provisions inserted into loan documents that I don't think anybody understands how they're going to work. And we had some of that back with terrorism insurance and really just terrorism provisions, where there was a period of time where everybody was working out the public policy, and the borrowers that signed those documents were sort of stuck with them. So just be careful.
Great point.
Yeah. Okay. Let me give you two takeaways. And then we're going to go, we got a few questions. We got a lot of questions here. I'll see if there's a few we can answer generally. I will tell you where your question's a little more specific, we're going to really need to address that offline. And know that the last page here will be contact information. Will and I are available here at First Service Solutions to address any questions you have. Keith Mullen is the practicing lawyer on this webinar, so Keith is available, I presume, to answer legal questions if you need legal input, so we'll have to take some of those offline. But number one, I cannot tell you how many times and these are sophisticated owners with large balance loans, where we'll say in the beginning of getting engaged that we need to see your guarantee. And the feedback I get is, oh, well, it's a non-recourse loan. And I say, I get that, but there will be some guarantee. And many borrowers say, no, I don't think there is. And you often see these not in a separate guarantee agreement, but in the exculpation section of your loan documents. That's where I'm seeing them more often. But how sad that borrowers, some of you maybe in this, you have these somewhere in your loan docs. There is no such thing as a non-recourse loan with zero carve out for it. That means you could go torch the property to the ground, steal all the rent, and guess what? They got nothing, right? So there will always be these carve outs. The question is, where are they in your loan documents and what do they say? And
then also how do they string together to say something bad?
Correct.
Yeah.
So it's not necessarily it's a one-to-one relationship. It could be a domino thing.
Absolutely. Thank you. Because you might read something, oh, I don't have anything that says I can't add additional debt. So I guess I can. But then you got to look maybe to the SPE requirements and things like that. So that's a great point.
Transfers and things like that, and boom, here it comes. You can't do that to do that, stuff like that.
Right. So know what's in your loan docs. If you don't know, if you're on this call today and you say, I don't know, and I wouldn't know where to get it, we're here to help. Because I've actually served as an expert witness on carve-out guarantees in my career. I've not written these documents. I've certainly read many, and Keith, you've written them. I'm sure
I've enforced them.
You've enforced them. So this group here pretty much knows. Okay, and to that next point, so do know what's in your documents, and do not, please, sign any new loan docs without having a CMBS expert review them first.
And even a modification, because of what we're seeing in just forbearance agreements and things like that, is that they're planting new de novo events of default that don't have notice and rights tied to them because they're articulated differently from your loan document. So there's all that sort of stuff.
Oh, fantastic point, because what I do see them doing, and an assumption even, for Pete's sake, you're assuming a loan and you take the loan docs as written, but a lot of times you'll see in those documents, the assumption agreement or forbearance agreement or whatever, they're going to try to shore up the missing parts of the document. If they see, we didn't get that language in right.
And 9 years ago when we first did this deal, this concept didn't exist. Let's add it in now.
So like the emergency law, you might see that now in forbearance.
Exactly.
I'm not. I'm just saying. Great point is you got
every document can be a new day.
Yeah. Every time the servicer looks at a request, they get a chance to relook at all this stuff. So we do, just so you're all known, this is never ever meant to be advertisement. I'm not meaning it that way, but we do provide a service where we review your draft loan documents before you sign a new deal. We don't negotiate deal terms. I don't know what the rate should be. I don't know any of that, but we'll be able to help you avoid some of these things that are just a lobster trap from day one. And a lot of them don't have anything to do with the carve-out guarantee provision. Okay, so let's turn it to the contact page and let me take some of the questions. Problem actually is the questions are about, I need a bigger set of glasses. Okay, there will not be a recording of the webinar. So I don't want that broadly sent around. So no, there's not going to be a recording. Somebody said, so did you really say this is in this new emergency law clause, you need to ask for lender approval to apply for PPP? You need to ask for lender approval to apply for PPP anyway, because at the end of the term, if you don't get it forgiven and you don't pay it back, it becomes debt, right? So, but is that what it's saying? I don't know.
Or you may have a prohibition of other indebtedness in your own loan documents. And
already without the emergency law provision.
Even without that.
What the emergency law provision was saying is that you may have to request the PPP before you can get it.
Right.
Yeah.
And you still need lender approval. But I think the short answer to that is yes, servicers are taking the position that they have to approve the PPP,
Absolutely.
even if it is eventually going to be forgiven.
Are you hearing any of them say, no, we don't approve?
No.
No, we should add that. That's a good point, Keith. Nobody's turning it down.
So you just need to watch what you sign.
Yeah.
Yes.
Yes. Now, so a question is, the EIDL is approved, there's someone's asking, I think, are EIDLs approved by servicer? Those are 100% of the times not approved. Those are additional indebtedness. It does go on as a loan. What should you do if you already got it? I think you probably need to speak to your lawyer, right? Or speak to just so, but you can't get approval for it. I know.
Yeah, there are a couple of lawsuits going on about that right now in the CMBS world. We won't speak to them individually, but you can look them up. But yes, Ann's right. They're not getting approved.
Somebody asked, great question, for some of these trigger events, who has the burden of proof?
Well, it's like any other contract law. The ultimate burden of proof is preponderance of the evidence.
But like for the part of the question, I didn't read all the way down, but like who determines what's waste and who determines whether it was intentional? And I guess like all good, that's just a legal debate, right? And who knows?
It's a legal debate that you could go in front of a fact finder. That means like a jury and a judge, and that's a very expensive place to be.
Yep.
So it's going to be that you need to stay within the range of reasonableness on your side and hope the other side sees it the same way.
Yeah, but again, to your point earlier, you got to pay all the legal bill, and even if you win, maybe, and you've got to be careful that it doesn't appear as if you're fighting them, and I don't know. There's a lot to it. So key is do not do CMBS loans without knowing these documents really where they're built with lots and lots of traps and triggers that will get you if you don't have a clear understanding of them. So with that, it is 3 o'clock. It's 2:59, but by the time we log off, I don't ever like to have these run over. I appreciate everybody attending today. And again, if you'd like, maybe Nick, can we go ahead and just send the slides to everybody that attended today?
Sure, yeah.
Okay, so we will send the slides out to all of you that attended. And you can, we're not recording it, but you're welcome to, I don't care if the slides get sent around, I mean, to anyone you want, because they're just, again, excerpts from a loan document. So there's really nothing special about the slides themselves. But anyway, thank you for attending. We'll get this out to you, and be sure and sign up for our next webinar on our website. If you haven't already, it's on April 8th. We're going to talk about, there's a lot of loans maturing in 2021, and they're obviously not going to be able to likely get regular financing because you're trailing 12-month revenue and NOI that probably doesn't support it. So we've got a couple people that will talk about what other options there are for you and some creative capital and other solutions. So be sure and sign up for that if you haven't already. Thank you very much. Bye-bye.